Let's dive straight into this incredibly tense, high-stakes standoff we're seeing in the crypto market right now. Welcome to today's explainer. If you've been glued to the charts this week, you've probably noticed things are feeling, well, uncomfortably quiet. The wild, dynamic volatility we're so used to has suddenly been replaced by a market that is just holding its breath. It's August 11, 2026, and the entire digital asset space is basically parked in one massive waiting game. But before we all start panicking over stagnant prices or those loud headlines screaming about a market meltdown, I want to ask you something. What if what we're looking at is actually a perfectly predictable pattern? Seriously, is this 2026 crypto crash a total disaster, or is it arriving exactly on schedule? Today, we're going to unpack the immediate macro pressures weighing us down, check out some really fascinating shifts in institutional behavior, and then zoom out to see how all this fits flawlessly into Bitcoin's historical 4-year cycle. All right, part 1, the great CPI standoff. We are currently locked in a dramatic frozen wait-and-see market. And I mean completely frozen. Traders are quite literally sitting on their hands. Why? Because tomorrow is the U.S. Consumer Price Index report. As the market nervously braces for that inflation data, Bitcoin is hovering right around $64,000, just stuck in this incredibly tight, nervous range. Over the last 24 hours, it dipped just under 2%, testing some key support levels. Basically, it's a market totally devoid of momentum, just waiting for permission to move. And if you want to see what that fear looks like, just look at the ETF flows from August 10th. We are seeing massive capital fleeing U.S. spot ETFs ahead of tomorrow's inflation data. Bitcoin saw a staggering $145 million in net outflows, and Ethereum had $14.6 million exit the gates. There is a glaring lack of fresh capital commitment across the board right now, but simply, nobody wants to be caught on the wrong side of tomorrow's CPI print.
Moving on to part 2, macro shocks and oil.
To really understand the crypto market today, we actually have to pan over to the energy sector and international relations. Overnight, geopolitical tensions spiked. The market had been pricing in hopes of a deal to reopen the Strait of Hormuz, but that optimism evaporated when Donald Trump demanded 50 years of compensation from Iran. The immediate result of that standoff, Brent crude oil jumped up to $89.08, completely erasing the relief rally we saw earlier in the week. And this creates a very direct domino effect that's punishing Bitcoin as we speak. Step 1, oil prices spike. And expensive oil means higher costs for everything from shipping to food. Step 2, that instantly fuels inflation fears. And step 3, those inflation fears mean the Federal Reserve might keep interest rates higher for longer. That puts heavy, immediate pressure on risk assets like Bitcoin. So yeah, it's a straight line from the Strait of Hormuz directly to your crypto portfolio.
Up next, part 3, whales buy, institutions sell.
Right beneath this surface-level macro tension, there is an epic, quiet tug-of-war happening with Bitcoin's supply. We've got a fascinating divergence in who is actually buying and selling while the rest of the market waits. MicroStrategy, which is traditionally one of the biggest corporate buyers out there, is selling for a 4th consecutive week. They just offloaded another 1,690 Bitcoin and haven't bought a single coin since June. But meanwhile, elite whale wallets, accounts holding over 10,000 Bitcoin, have surged to a 6-month high. We now have 90 of these massive wallets accumulating heavily. The big takeaway here is captured perfectly in this quote from Sentiment Intelligence. Supply is rotating towards stronger hands before the next major market fluctuation. What we're witnessing is a fundamental transfer of wealth. The smaller retail holders, the quote-unquote weak hands, are shrinking, while the absolute largest wallets are gaining massive presence again. Historically, when supply rotates to these strong institutional hands, the next big market move tends to be an incredibly bullish one. Which brings us to part 4. Riot's massive AI pivot. Speaking of massive institutional shifts, look at this monumental pivot happening in the mining sector. This tells us a lot about where corporate capital is flowing right now. Bitcoin miner Riot Platforms just signed an explosive $9.1 billion 20-year lease deal with the AI company Anthropic to lease out their data center capacity in Texas. Let that sink in. This isn't just some side project. This is a massive, dynamic reallocation of energy and infrastructure. And the market absolutely loved it. Riot Platforms stock wildly jumped 20% right after the announcement. Wall Street is placing a huge premium on using energy infrastructure for artificial intelligence compute rather than just crypto mining. It's a vibrant trend that's literally pulling corporate treasury demand away from Bitcoin and pointing it squarely toward AI. Let's look at part 5, altcoins and regulatory gridlock. Back on the charts, While Bitcoin consolidates, the altcoin market is reacting with some rapid-fire volatility. Most majors are taking a pretty big hit. Ethereum is struggling to maintain momentum below $1,900, and XRP is hanging by a thread, retesting that critical $1 psychological support. But look at Chainlink. It's a notable outlier today, surging nearly 5%, mostly driven by institutional demand for Oracle infrastructure and a highly bullish $200 price target for 2030 from Standard Chartered. Now, why is XRP looking so vulnerable at the $1 mark? Well, it's directly tied to this intense regulatory gridlock. The much-anticipated Clarity Act is completely stalled out in the Senate until at least September 15th, and prediction markets currently give it only a 22% chance of actually passing into law this year. On the flip side, the SEC does have an open meeting scheduled for August 14th to discuss a potential safe harbor for startups. But for now, this regulatory uncertainty is acting like a heavy anchor on most altcoins. Finally, part 6, the halving cycle context. Let's release some of this day-to-day tension by zooming all the way out to the 4-year macro view. When you do that, the current market behavior shouldn't actually be a surprise at all. Look at the timeline of Bitcoin's post-halving peaks. In 2012, the peak came 12 months later. In 2016, 17.3 months later. In 2020, exactly 18 months later. And for the 2024 halving, the peak hit 17.6 months later. Guys, this is closer to a metronome than a random market. A 12 to 18-month post-halving peak, followed by a long decline, is written into the calendar like clockwork. And that brings us to our reality today. Yes, the grim 27.7% drop we've seen in the first half of 2026 feels awful, but it maps perfectly onto the post-peak downslope of the 2022 cycle. We are currently about 8 months past the October peak. History isn't just rhyming here, it is literally repeating the exact same verse. This decline we're in, it's just the bear phase of a clockwork cycle, arriving right on time.
So, what is the ultimate line in the sand? It's the $61,500 support level. This is the 100-day moving average, which smooths out all the chaotic daily noise. As long as we hold this absolutely critical level, the medium-term structure of the market remains entirely intact. If tomorrow's CPI print comes in hot, this is the exact line you need to keep your eyes glued to. If it holds, the structure survives.
Which brings us to one final thought. We have elite whales quietly accumulating at a 6-month high. We have a crash that is tracking flawlessly with historical post-halving cycles, pointing to a potential market bottom just a few months away around October. I'll leave you with this to chew on. Is today's frozen, fear-driven market simply the final, quiet setup before the historical cycle repeats itself and the market goes kinetic once again? Keep a very close eye on that CPI data tomorrow, and definitely watch that 61,500 line. Thanks for joining me for this explainer, and I'll see you next time.